What is up, everybody? This is Stock Market Education, and today we're going to be talking about 3 stocks to watch for May of 2020. Let's get into it. The first stock I'm watching is Tesla, currently trading at $723 a share today. Keep in mind that Tesla is expected to report earnings on April 29th, and analysts expect to see a negative $1.22 per share, which is a big leap when you compare it to last year's earnings of negative $4.10 per share, and with everything that's been going on in the markets. And losing $1.22 per share seems a bit high to me, but the big question is, should you buy ahead of earnings or not for Tesla? At the moment, I'm not planning on buying Tesla stock ahead of earnings because Tesla's price has skyrocketed for the past 3 weeks, pretty much in a straight line, and clearly being overbought in the short term, which isn't something that you'd want to see if you were going to do an earnings play. The most important thing is that there's too much uncertainty in the markets today. Who really knows what numbers are going to be reported for Q1 and especially for Q2? It's really hard to say. For the long term, Tesla is in the driver's seat for the car industry, no pun intended, but not really. And you know, they're at the forefront of electric and autonomous vehicles, and Elon Musk has been an absolute genius when it comes to bringing the cost down for their cars so that the average household can afford them. And during the recession, think about how devastating this is for the other car companies. Look at Ford, for example. They have $53 billion worth of debt on their balance sheet, and keep in mind, Ford only has a market cap of $20 billion, and they're in a position now where they have to take out even more debt at a high interest of about 9%. There's a real possibility that Ford goes bankrupt in the next 18 months. What does this mean for Tesla? Well, it'll strengthen Tesla's market position and the fact that owning an electric car is more cost efficient to the consumer over time, putting Tesla in even a better position. Up next is MGM stock, currently trading at about $14 a share. And MGM, along with every stock in the hospitality sector, will take the longest to recover, as they usually do with most recessions. But for the long term, MGM's growth strategy is extremely compelling because they are currently in talks with Japan to open up properties in the country. And look at how many big players dropped out of the race. Las Vegas Sands, a giant integrated resorts company, Melco Resorts Entertainment, Caesars Entertainment, which is actually a company that I used to work for before the world shut down, and it looks like it's MGM's race to lose at this point in time because MGM was the only company to actually submit a request for a concept to authorities, and these concepts look absolutely incredible. Also, late 2019, MGM sold Circus Circus for $825 million, which in hindsight was a perfect selling time. They probably wouldn't have even been able to find a buyer this year, and Circus Circus, I mean, it pretty much was a dump. The property makes money, but not like a Bellagio or Aria or Park MGM by any means. This is a stock that I just started buying after I posted an analysis video on it, and I wanted to buy more shares, but the price shot up 60% since, so I'm kind of stuck at the moment. But if the stock goes down to $9, I'm going to load back up on shares, and if the stock goes down to $7 is when I'll really load up. But like I said, it's going to take a long time for MGM to get back to the levels we saw in 2019. Probably about 4 to 5 years, and also keep in mind, MGM's stock price fell all the way down to $3 a share during the peak of the financial crisis in 2008. And most would say that we're in a much worse financial position now. However, MGM was not the same company in 2008 as it is today because they have much more upscale properties now than they did back then. The last stock to watch on the list is Uber stock. I haven't done an analysis video on Uber stock for a long time. Leave a comment down below if you want me to make a new analysis video on Uber or any stock for that matter. Uber is currently trading at $28 a share, and before the economy got put on hold, 2020 was supposed to be the year where Uber goes from losing money to making money, where they shift their goal from increasing market share to increasing their bottom line. And the stock started tanking and tanking until the CEO pretty much told everyone that they had enough cash to ride out the storm for 2020, even if they have a worst case scenario, which this is the worst case scenario, because they still still have $4 billion worth of cash, which is pretty much when the stock bottomed at $13 a share before reversing over 100% to the upside. And their Uber Eats segment has seen a massive spike in activity across the pond in Europe, jumping 59%. It seems that we're getting a huge change in the landscape of the restaurant industry right now, and when the economy comes back, people are going to need Uber rides to go to and from places. Right now, $28 a share isn't a bad price. However, I expect Uber, along with most stocks, to fall dramatically over the next couple of quarters. Thank you guys for watching the video. Click the like button and subscribe if you enjoyed this video, and have a great day. Bye.